Hi, thanks so much for tuning in. You're watching the Mutual Fund Show. This is BQ Prime. My name is Alex Matthew. Now, a lot of things have happened over the past couple of weeks, and that has drawn attention to the whole idea of value investing. Well, the question is that is value investing something that you should consider only in these times, or is it something that you should have as a regular approach? And I'm hoping that the conversations that I've lined up will help you draw that conclusion. My first guest is Raunak Onkar. He is the head of research and co-fund manager at Parik Financial Advisory Services. Raunak, thank you so much for taking the time. And as someone that is very well known and a representative of a fund house that is very well known for its approach to investing, its value approach to investing, and to its approach, bottom-up approach to investing in stocks, the first question with all the headlines floating around is how much attention do you pay to a bank failing or a couple of banks failing in the US, a Credit Suisse buyout by UBS? How much attention do you give to them?
Thank you, Alex, for having me on the show. I think your question is quite relevant because every time there is a macroeconomic event which adversely affects the market movement, there is, of course, this question again that, does it really affect the companies that we own? So, of course, we pay attention to all these macro events. Some macro events have a tendency to spiral into company-specific issues, sector-specific issues. So we, of course, keep a track on macro events from that perspective. But from the point of view of the companies that we own, like you correctly said, we have a bottom-up approach to looking at businesses. So whenever any macro issues happen, whenever the crisis that you mentioned about banks in the US and even the Credit Suisse crisis right now, whenever those issues happen, the primary focus is on the portfolio companies we own, the sectors we know very well, and we try and understand whether these sectors will be unaffected or not by what is happening. And if the answer is yes, the sectors will not get affected too meaningfully in the short term, then we remain holding them. If the sectors don't fail in the longer term test as well, we say, okay, these companies can be held and the business models can be played out over a cycle, and we can remain invested in these companies. So yeah, it worries a lot. We look at different things, and sometimes the headlines are very stark, and things are happening on a daily news flow basis. But I don't think businesses change that dramatically unless they are directly impacted by the happenings in the macroeconomic environment.
Okay, a couple of questions on the banking space, and I'm curious more than anything else because of your function as head of research as well. You study these companies and institutions very closely. Unlike the 2008 financial crisis, where you had credit problems that resulted in the failing of banks, in the recent past, we've seen equity runs on banks, which have led to crisis of confidence, which have in turn led to runs on banks and the failing of banks. How does a bank management resolve this, or is the solution that the regulator comes in and reinforces confidence?
I think a crisis of confidence requires all of the above things that you mentioned. One is the management's ability to confirm to outsiders, the depositors, the shareholders, that the strength of the bank is sound. Even the regulators stepping in and guaranteeing some of these things can also help. And we have seen that happen. If you have seen the headlines in the past couple of weeks, we have seen that regulators have also stepped in, and it's being monitored on a day-to-day basis. We get daily updates of all these through the media. I think a lot of the things which we know of how banking industry works and the rules that the banking system follows, we are right now seeing a little bit of unprecedented regulatory activity, trying to make sure that the system remains intact and the confidence remains intact. And which is, I think, a great thing because things don't so dramatically change. The only thing we have seen dramatically change is the rate of change of interest rates from, say, pre-COVID to during COVID times. The interest rates reduced dramatically, and from the post-COVID unlock time to current scenario where the interest rates have gone up quite dramatically. So I think any sharp moves in some of these macro events can cause disruptions in the asset books of many banks, and I don't think it is unknown to the regulators or the bank management itself. I think the thing that you mentioned, the crisis of confidence, that is something the banks and the regulators will have to manage more meaningfully.
An incidental impact that is perhaps not being discussed to that extent, that I'm curious to find out what your views are here, is that with this situation emerging in the banking system globally, particularly in the US and Europe, uh, there is a possibility that there will be more watching of risk when it comes to credit that could have a fallout on economic activity on certain companies as well. In the portfolio of stocks that you hold that are in these geographies in the US, do you foresee any impact there, or are they more or less insulated because of the kind of sectors that they play in?
So one of the filters that we put in for any company we invest in is the indebtedness or dependence on the outside capital markets for any company. So if a company that we like is constantly raising capital from the debt market or the equity market, then that's a difficult thing for that business to sustain because it does not have a sustainable stream of cash flows. So one of the filters that we have is sustainable cash flow, which the company generates on its own, which can be redeployed and reinvested in the business's growth. And occasionally the business can tap into public capital markets like debt markets or equity markets to either raise capital periodically. But hopefully they don't dilute the existing shareholders too much. That is the expectation from these companies. So when you have such companies who generate cash on their own, they don't depend too much on the debt markets or the capital markets on an ongoing basis. So in a way they are insulated, but at the same time, the overall market can correct in terms of valuations, and these companies being large businesses that we own globally, they also have probably a valuation impact on just the market cap of these companies, but the underlying businesses will not be affected that dramatically. That is our anticipation.
Okay, fair enough. Now, the headline, of course, of this conversation is value investing. And I'm trying to get my viewers to get a sense of how you perceive value in the current environment. And a different way to ask this question is to also ask, Raunak, how much cash are you holding? And a lot of your peers in the industry are holding elevated levels of cash. You're holding more than most at around 20%, if I'm not mistaken. Why is it that you're holding so much cash?
So the parameters of value investing have evolved over a period of time, but they have basically remained the same from the point of view of discounting future cash flows today. So most people are aware of the idea of DCF, which is a discounted cash flow model, where we can discount companies' future cash flow earnings to the current price, and we can get an estimate of what this company's price today should be, and whether it's a fair price that we are paying based on our expectation of how the future will be. So when you look at that, we definitely want companies to keep generating cash flow and keep growing in the sectors that they operate in. So from that point of view, value investing doesn't change. The only thing that changes is how much the rest of the market is willing to pay for that future payoff. So when the rest of the market says that they will pay whatever it takes to participate in an opportunity and bid up the price of the shares today, then we step away from that particular transaction. We said, okay, we'll wait and watch till the prices come in our comfortable zone, and only then we will participate. So from that point of view, we have about 20% cash right now in the FlexiCap fund, and even close to 20% in tax saver fund that we manage. And there's a reason for that, because we are not finding attractive valuations for the companies we like. And that does not mean there are bad businesses out there. It's just that the good businesses are bid up by the market, and it's not a great opportunity to invest in them right now. But the moment we find something interesting, we can allocate a significant chunk of that cash immediately. So I'll give you an example from the past where this has happened a couple of times, where I think somewhere during the late 2017, early 2018 period, when we had a mid and small cap rally in our domestic markets. Of course, we already had the investment in the international piece, which was solidified in that, and which was not touched at that time. But the domestic market was so elevated that we could not allocate meaningfully to the domestic market. So at that time, we were in fact in higher amounts of cash. We were close to 25, 27% of cash at that period of time. But gradually, as the markets cooled off, the valuations cooled off, we started deploying that cash. And even the same situation happened just before the COVID pandemic hit us. We were about 11, 12% in cash in the portfolio. And that actually helped us participate in the ideas as the market crashed immediately after the lockdowns began. And some companies which were always on our radar and we were waiting for the right prices for those companies, when we evaluated that the companies won't be impacted in the longer term too much, we were able to meaningfully participate in them because we had cash on our books. So the cash is essentially residual. It is not something we strategize that we should have some amount of cash in the portfolio at all points in time. It is just residual. And if you see the fact sheets immediately after the COVID lockdowns hit, we were actually at 0% cash at that time. So there's a wide range in terms of how we look at valuations, and based on valuations, we will essentially determine if we want more cash or less cash in the portfolio.
So the timing is incidental in that sense, is my understanding of it. It's not just because of possible issues in the financial system globally. It's just that you're not seeing value in the stocks that or in the companies that you like. And when you see that opportunity, that will happen. The fact that it coincided with the COVID-19 pandemic or otherwise is incidental. Then
Yes.
the other aspect that I would want to speak to you about is, of course, your portfolio and the shifting nature of that portfolio. Because of regulatory thresholds, you're not allowed to incrementally add to your foreign holding because of the thresholds having been breached, as a result of which that foreign holding has reduced quite dramatically. The question is, are you seeing equal opportunities in the India market that fit the parameters that you've listed to invest in companies?
So the parameters that we have for domestic as well as global stocks are actually the same. So we don't distinguish in terms of the quantitative and qualitative parameters we look at. So in quantitative parameters, some of them are very obvious. Those are longer term trends of sustainable business growth in that particular sector, or that particular business has a very long runway ahead of it, and they are able to profitably scale that business in that particular segment. In qualitative terms, we have the parameters like the quality of management, where they have demonstrated a good ability of running that business well. At the same time, they are minority shareholder friendly, and they have a track record of that over a period of time. And in other qualitative parameters is also the valuation of that business. So that business should not be extremely highly valued as compared to its peers or compared to itself over a period of time to participate in that same opportunity. So the same parameters apply for both domestic as well as global stocks. But with the regulatory impact that we had faced last year, when RBI had told the entire AMC industry not to invest or not to remit money abroad to buy international stocks, is because the industry limit of $7 billion had been breached, and which we complied with. And interestingly, all the incremental money since then, since last year, has been deployed in the domestic market wherever we had a chance to invest in. So clearly, the domestic market is not looking very attractive in terms of valuations. Hence, we have a buildup of cash, and somewhere close to 27-28% was the average threshold of our international investments. That has come down close to 16-17%, which is natural because those stocks price also has fallen. At the same time, our allocation to international stocks has reduced in this period of time. But both these parameters remain the same. So investment filters for both these geographies remain the same. It's just that the valuations in domestic market are not very attractive, so that we cannot deploy our cash very meaningfully at the moment.
Just out of curiosity, assuming that the regulatory environment does not change and you aren't able to remit money into international assets, you're okay with the scenario where this gets skewed even further? Because that around 30% international exposure was one of the major talking points for such a long time for PPFAS, that diversification of assets into international assets as well.
See, number one is that we need to work in the regulatory environment we are operating in. So if the permission never comes, we will have to incrementally invest only in domestic markets, which we have done for a long period of time. So PPFAS has a history of only domestic equity, which is much longer than our trials or our investments in the global market. So that is number one. Number two, yeah, it's fine. So the whole idea behind investing internationally is not to deliberately have a global focus, but the whole idea was to diversify the risk geographically and also participate in unique companies which are not available in India. So giving an Indian investor an ability to invest in INR terms and participate in the global companies which otherwise they will not be able to invest, and they can take their money out, redeem their money out in INR terms, and we manage the currency risk at our end by hedging the exposure. So that gives a very balanced, diversified portfolio for a domestic investor to invest in. That was the only intention for going abroad. It's not necessary that such companies are not available in India. There are great companies in India. We will always see new listings in India which are at par probably with some of the global peers. But there are some global companies which don't have any comparison. Like, for example, you won't have an Alphabet, you won't have an Amazon in India at the same scale as they operate globally. So some of those unique opportunities we will miss investing in. But that doesn't mean that domestic market is not vibrant and will not be able to invest in domestic market after that.
All right. My last question is obviously it's as going back to the first question. You are a bottom-up approach, and there are these very clear triggers that you're watching out for. Do you anticipate that it'll be a while? And I'm not asking you to quantify, but just based on the current landscape, based on everything that we're seeing in terms of the global headwinds, do you anticipate that you will have to wait, play the waiting game for longer, heading into the next financial year?
I think the waiting game from price point of view is very hard to predict. What I find a little bit easier to predict, or the trend is a little bit obvious nowadays, is that the whole era of easy money and low interest rate is behind us. So any person or any investment decision that was based on having cheap capital available, I think that has to go out the window. You need to rework all these plans and make sure you factor in the current interest rate scenario going ahead. And once that happens, then we will see which are the better business models which will survive, which will thrive in that new interest rate period. So there's a prolonged easy access of capital available across the world, and that has suddenly disappeared. So many companies who relied on that business model, they will really have to come up with a sustainable cash flow generating model from their own. I think that is the advantage of being a bottom-up investor, where you can actually track these changes based on the macroeconomic events, rather than focusing on the macro first and then trying to drill down top down that which sectors or which industries will be benefited across because of the changing regime. The good business has always remained good. So if somebody figures out a way to have a sustainable cash flow generating model, they will survive. I mean, there is no doubt about it. And these companies are around, these examples are around. So any stock market historian will tell you that companies who sustainably generate free cash over a long period of time do better for investors, and they return money to shareholders at a much faster rate than some of the other companies who are dependent constantly on the generosity of the capital market.
Well, I couldn't have put it any better. Thank you so much for taking the time. Pleasure speaking with you.
Thank you, Alex, for having me.
There you have it. That was the fund manager perspective, a fund manager who is devoted to the value strategy. And as he pointed out, he's looking at his parameters more than any of the headlines. But let's broaden this conversation and talk about the value strategy per se, and whether or not this is the only thing that you should look at when you're investing. Should you have a combination of both value and growth, and what you need to bear in mind when you're choosing funds that operate in this strategy? Joining me are Gurmeet Chadha, the managing partner and CIO of Complete Circle, and Anant Ladha. InvestAajForKal is who he represents, and he's got more designations than I have breath to speak about. But thank you so much to the both of you for taking the time. Gurmeet, I'm going to throw it to you first. A lot of headlines in the recent past that are making investors here in India also a little jittery. If you have a value approach, first of all, what should you parse from these things? If you're seeing a little bit of weakness in the equity market, should your ears pop up? What should you bear in mind?
So, Alex, I think why you're hearing a value approach is because the growth has stopped, performing well. Is grossly underperforming after beating value over a long period, and typically that also coincides with the interest rates. Right, we were so used to zero interest rates and money printing by the central banks, starting 2008, leading up to various crises, right up to COVID and the war. Growth took a precedence because markets started valuing growth more because there was no alternative. We call it TINA factor, right? Because the fixed income yields were so low, which is also the discount factor. So whenever interest rates have gone up historically, right, the discount factor goes up, right? Because now today the cost of not doing anything is 7.5% in India. Buying a government bond, right? 2 years, 10 years. Same for in US, you had 2-year bond at 5% before this crisis, right? So 5% in dollar terms virtually for just buying the US Treasury, right? So I think that's why I'm more on the camp of having a blended approach, right? More in terms of value at a reasonable price or growth at a reasonable price. So too much of value chasing can also lead to you being stuck and you confusing price correction with value. So, a lot of these new age companies correcting 50% don't make them value buys. Credit Suisse was 95% down before it was taken over at further 60-70% cut, right? So I think a blended approach is what you should have, and a portfolio should reflect different styles, because different strategies do well over a period of time. So it is not this versus that, right? And there's a saying that you can't take the last bogey out of the train. Some part of the portfolio will underperform, which actually is a sign that you are diversified, because the cycles are shortened and you never know what can work, and rotate very, very fast. So I am more in the camp of blended approach and looking at, value in correlation with whether that value is justified by earnings.
Okay, I want to throw it to you, Anant, before I delve a little deeper into it. Do you also think that a balanced approach, as Gurmeet is pointing out, is the way to go?
See, I will try and point out some of the data points which are very interesting to watch out. It is from international market, but it will give us perspective about growth versus value. There is something known as Russell 1000 growth and Russell 1000 value. If we check out data from 1979 to 2020, 2021, and compare both the index, we find that both have almost equivalently performed. Both have given returns around 12 to 13%. But there have been different patches of returns. For example, Russell growth outperformed between 1989 to 99, and then it outperformed in 2009 to 2020. Versus if we talk about value Russell, it outperformed in 2000 to 2008 period, and it outperformed in 1979 to 88 period. So we have to understand that there are cycles of growth and value. As an investor, I personally have three options. First is I can randomly choose any of these style. I can go with value, I can go with growth. Second, I can tactically choose a style. If I have basis study behind the selection, I can tactically choose a style which I think that can perform significantly in coming times. And third option as an investor which I have is that I can combine both the approaches and choose a blend of two approaches. There is risk in all the three options. In first option, you need luck on your side. In second option, you need skill on your side, that you should be skillful in selection of which style can outperform in coming times. And when you are choosing a combination of both, then probably you will always have some of the underperformers in your portfolio. So there is something very interesting which has come, as Gurmeet rightly mentioned, GARP, growth at reasonable price. That is looking to buy out growth companies which are giving good results, good EPS growth, good sales growth at reasonable price, and not overpaying for that. So that is something which we can look at.
Okay. Gurmeet, tossing back to you on the value approach. And I was speaking, the first half of this conversation was with PPFAS, which I think a lot of people recognize as a fund house that takes that approach. As a student of the space over a period of time, how would you describe to the investor what instances you've seen of a value approach succeeding? Maybe you can talk about a fund manager and their approach underperforming over a short period of time or over a period of time, and then having their bets rewarded.
So many of them, Alex. So, I've been in this industry for more than 18 years now. So Naren actually underperformed quite a lot, in the growth phase, where you had high growth, people who had, very high growth strategies like Motilal or Axis or some of the other fund houses, which did very well. And Naren was always on the value side. Right? So if you look at Discovery, just to take an example, it's not a recommendation. If you see the top holdings, you will find a Sun Pharma, you'll find an ONGC, the portfolio. You'll find some of the PSU banks in the portfolio, right? You'll find a Bharti, right? Within IT, probably you'll find a Tech Mahindra on the portfolio. So his approach was of picking up something which is looking more reasonable, which is fundamentally good, but the market is under appreciating it for a while. There's another guy who I've tried very closely, and one fund where I have a personal SIP, is SBI Contra. Another very good guy, done very well last 1 year. In fact, if you look at his portfolio positioning, he's more contrarian. I would not call him pure value, but it's a bit of a blend. So he's like 13% on cash, and he's been on cash now for a while, because he thinks that because of the way central banks are tightening, the cash also will give a lot of opportunities. In fact, he uses index futures also to hedge, which I've not seen very fund managers to do that. So his net long position on the fund was just about 77, 78%. And last 1 year return is actually double digit, despite So I'd say there are lot of them who have done well. We've seen even stock wise, ITC underperforming for 3 years, and now being the darling, last almost doubled from the low. So that's why I said I think a blended approach is better. It's not that growth is good and value is bad. And I agree to what Anant said. Some bit of could be core and satellite also. If you think that interest rates are going to be high for a longer period of time, and fixed income also has become equally attractive, and now with gold also picking up with the kind of volatility in banks, there is no harm in keeping a satellite part of the portfolio where you can increase weightage, by 5, 10, 15% depending upon your view on the market.
Fair point. Anant, what are the fund managers that you have looked at? And I think Gurmeet very nicely put, he has chosen, I think, a fund that you also like, if I'm not mistaken.
In fact, Alex, these were the exact two funds which we were exactly discussing right before this shoot. So it was a pleasant surprise. And I think I am also liking these two funds because they are being managed in quite different style. For example, Naren is managing Discovery. Since it is a 20,000 crores plus fund, it is mainly focused on large caps. They are heavily weighted on large caps. Versus if I talk about SBI Contra, they have almost 40 to 45% in mid cap and small cap, and they are taking that exposure. So both these funds are in the same segment, but managing these funds differently, which is giving a good blend. And looking at the present market scenario, depending on the risk appetite of an investor, I think combination of both growth and value can be a good thing to look at, especially mix something like 60% in growth and 40% in value is something which we can look for, but completely dependent on the risk appetite.
Sure, fair point. One of the points, Gurmeet, that you mentioned that I raised in my first conversation today was cash. And Raunak pointed out that he's holding 20% cash right now. And I asked him, I said that that's a different way to ask whether you see value in the market because you're holding that much cash. The question really is, if you have this diversified approach that you are suggesting, does it also make sense for the investor themselves to have a slightly moving approach to having sometimes more cash in their books, to having a larger exposure to fixed income? Of course, like you pointed out, the risk-free return right now is really attractive. Is that something that you should do?
So somebody said that cash is also a position. And if it becomes a position, if it's yielding you 7%, even in a liquid money market fund. So when you are uncertain, about how things are going to pan out, I'm more a believer on staggering it than timing. Because what happens is that if you hold it for too long, so you need cash and courage both to take advantage. And while cash will be there, sometimes the courage disappears. When you see large movements, the courage to deploy goes away. So it's good to stagger it, over a period of time. And if you are not good at it, and there are funds which can do it, which are the hybrid funds. In fact, I personally think that there's been too much discussion on balance advantage. I think even a pure hybrid fund now, which is like a 70-30, kind of a combination. Because a balance advantage fund will have to use arbitrage, and the expense ratio can catch up. You're paying a lot for taking an arbitrage position in the fund. A pure balance fund with a 70-30, 75-25, with debt also attractive and likely to remain that, could also be a decent combination if you think that.
What I was trying to get at is, we've established that having a growth plus value approach and a mixture of the two is better than any one single approach, because you will be better diversified. But I know, Gurmeet, that you also are somebody who buys a certain number of shares of HDFC Bank as a strategy every month. This is something that you're building over a period of time, rather than looking at, is HDFC Bank price hitting the level that I think is appropriate? You have a strategy where you invest over a period of time. Is that the approach that every investor should take? Come what may, over a period of time, if it suits my long-term requirements, I will deploy in these funds that I choose.
So I think the SIP should definitely continue, whether it's an SIP in stocks or fund should continue. Overweight, underweight should be dependent on the liquidity you have. So don't disturb the discipline. I think the mistake I did in 2008 was I disturbed that discipline. I got carried away. I used to work for a fund house, and I saw queues of investors lining up in 2008 to redeem money. It was overwhelming for me. And I realized one of the SIP could not be stopped. There was some technical error, and that gave me the best returns. So I think never stop the SIP, never stop the discipline, because it takes the emotion out of the equation. On incremental money, each to his own. I mean, as I said, personal finance is more personal, right? So if you're getting too jittery, I might just continue with the monthly discipline. And if you've seen cycles, I think the better strategy is to stagger, not to time.
Yeah. So which is why, because if you study and various instances, you could extrapolate and say, had I deployed on January 3rd of this year and looked at a point, you'll be significantly miles ahead, right, Anant? But it's all wisdom of retrospect is flawless. So from that perspective, do you agree timing the market is practically impossible? Staggered approach is the best way?
See, I have 2 points to discuss over here. Firstly, before giving you any good returns, be it SIP returns or be it a mutual fund lump sum returns or be it direct stock equity returns, market will always test you. If market has not tested you yet, I am very sure that you have not made big money out of this market. So market will always test you before giving you big returns. Right now, I think it is only the quarterly exams which are going on. We are seeing that our maybe 1.5 year SIP returns are almost equivalent to zero. They are not giving any returns. But there might come a situation that 5 years down the line, we see that our SIP returns is yielding less than maybe FD returns, or maybe yielding less than is even negative. But that is the time where you have to stick with your SIPs, keeping the long-term vision in mind. And that is the time market is probably getting ready to give you big returns. So that is one thing. SIP is a systematic approach, which you have to always make sure that you are following in a disciplined way. Secondly, if we talk about cash, obviously you can take out some of the cash positions from your portfolio in good times. Usually what happens is we try to cash when the market has already corrected. We feel that now let us take out some money and keep some amount in cash. This is not the right time to take out your money. Right time is when you are seeing above 15, above 20% return on almost all your funds. You're very happy with your portfolio. You are probably thinking to double down your SIPs. That is the time. If you think that you can time the market or can take that tactical call where you can gain maybe some extra returns, that is the time where you need to move some of your portfolio into cash. Not when market has already corrected.
Fair point. I think we've discussed some really interesting points, and incidentally, both of you like the same fund managers and gave the same examples. So that kind of reinforces the thought. Gentlemen, thank you so much for taking the time. By the way, if you've got any questions for any of our panelists today, don't hesitate to write in on the comment section and I'll get answers for all of those questions. Thanks so much for taking the time. This is BQ Prime.